Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. You're listening to Destination Retirement. Welcome. Hope everybody is having a great weekend, a great week. Hopefully everybody has enjoyed summer. Can't believe school's back for the kiddos. Certainly was a quick summer, but I want to thank everybody for listening today. If this is your first time, Kuhn Capital Partners, we are an SEC-registered investment advisory firm headquartered here in Chicago. We're actually in Oak Brook. We do have clients in, I think the most recent statistic is 24 states. We're working with over 300 families, so you're not just a number. And if you do listen to the radio show, you know that our main goal is to really just try to provide education that can provide you, the listener, with something to think about. I think the job, candidly, of most advisors is to raise the financial IQ of individuals. Unfortunately, it's my belief that on the radio, it just doesn't happen. Generally, they're more sales pitches than anything, and I guess our sales pitch is education. We certainly do talk about products, investments. We talk about tax reduction strategies. Everything we talk about on the radio, as you know, is for informational purposes only, because we don't know your situation. And so you should never act on an investment just simply because we talk about it on the radio or you hear it on the radio. And I want to make sure that we make that very, very clear. So if you'd like to talk more about your individual situation and dive deeper into what you're looking to accomplish, what you feel you're not getting if you're working with a current advisory firm or you're managing the money on your own, we can certainly set that initial call up, 630-492-1912, 630-492-1912. We do have things that we regularly talk about on the radio. That's simply because I believe that they're not talked about in the really just enough, candidly. When you look at, what's going on in the world today, maybe the markets will never go down. And, excuse me, that is a great thing if the markets just continue to go up. Obviously, we've been in a very, one-way trending market, short of, certainly some blips, of course. But when you look at kind of financial planning and you look at, the client bases that we work with, generally, when individuals reach out to us, there's something missing, and it could just simply be that, they want to have a second opinion. They want to talk about strategies like the banknotes, for example. And the banknotes, I don't know why they're such a polarizing topic, or it's shocking to me, just why so many advisors, have such I don't want to say negative thoughts on them. It's just when an advisor doesn't do something or offer a strategy, generally you're going, at least it's my belief, that you're going to, very few advisors, my belief is that they're going to, say an investment is good unless they bring it to the table. Because if you are working with an advisor and you ask them about a strategy that you heard that didn't come from them, immediately it's going to put them on the defense. At least that's my belief. And everything we talk about on the radio is my belief. And doesn't mean I'm right, of course. It's just, I've been in this business for an extended period of time. And I, talk with a lot of investors. I talk with a lot of advisors. I talk with, people and other individuals that work with other advisors. And so I have a lot of knowledge in, what's going on in the marketplace and how advisors react to, things and strategies and options and topics that they don't bring to the table. And as you know, I have a real problem with the financial services industry because my belief is it's really become more of a asset gathering space than true risk management space, because of the job of an advisor that I believe in a job of an advisor is to have candid educational conversations about different investment options, not just a 60-30, 70-40 balanced, quote unquote balanced portfolio. And we continue to see that. And it's shocking to me in that $1 to kind of $20 million space. So, $1 to $20 million investor, just how basic their portfolios are in the lack of true risk management. Well, I can't say risk management because I'm not, in the day to day, but, or hedging. I think hedging is a better, phrase that exists in these portfolios, because when you look at the job of an advisor, at least we believe that it's to really spend a lot of time on the strategies that, have some sort of defined outcome. And when you have a defined outcome like the banknotes, even though they shouldn't be polarizing, because, banknotes are just simply not in my opinion, a cutting edge strategy. Maybe they were, in the late 90s, early 2000s, but they just are now available at a minimum investment, that is, that just wasn't readily available. And so I think that's why most advisors don't do them. But anyways, that's my soapbox on lack of education in the advisory space. Banknotes are still pricing obviously very strong. We did we call it the Mini Mag 7, so it's 3 Amazon, Google, and Meta, and I think we did put the prospectus is up on the website, so you can take a look at that. That priced at 27% with 30% downside on your coupon payment. So as long as those stocks don't go down 30%, and it just takes one stock to trigger that monthly non-payment of coupon. If one of those stocks go down 30%, then you're not getting your coupon for that month. The only difference between our traditional index-based notes and the stock-based notes is more times than not we'll do a 40% on the principal side. So I encourage you to look at that. The index-based notes are still pricing between 10 and 14%, depending upon whether it's tier 1 or tier 2. But it's real strong, and people are searching for yield. People are searching for yield. People are searching for some sort of defined outcome. And I think that to me is when the rules of the road, because it's a prospectus item, you can read the prospectus from the bank. And again, most of these banks you're going to recognize. We looked at, year to date through July, I believe we're right around 64 million in new issuance. So that puts us on kind of a, run rate over the, if we look at calendar year 26 of over 100 million. I wish it was $1 billion, because I think, the strategy is so strong. Our largest issuer of the banks, I believe it's north of right around 20%, was Goldman Sachs. So it's a Goldman Sachs note. And the beauty of these strategies is you can read the prospectus, and you should read the prospectus, and you should do that education, which is why we put these on the website. And so still pricing strong. Bison 2, energy, oil prices, as we have an energy fund that we think oil prices, could see triple digits again. Obviously, I don't know. You don't know. Nobody knows, especially in the commodity space. You have significant movement. But it looks like oil prices are, at least higher oil prices are here to stay, and potentially trending significantly higher. When we do underwriting, and for those of you that don't know, Bison 2 LP is a fund that invests in non-operated working interests in the Permian. And so we're a equity partner in the majors projects, in some, small, mid-majors, but the bulk of, what you're going to see in the companies that, we have a very, very diversified fund. You're going to recognize them, or you can do some, quick due diligence on them and see that they have, are experts at, what they do. We don't drill. Obviously, we don't want to drill. It's not our area of expertise. And so we let the Conocos, Exxon, Chevrons, Matadors, Mewborns, Vaqueros, et cetera, of the world do the drilling. We just have 0.5%, 1%, 5%, 10% ownership. And we have a single fund that has currently around 51 producing wells. We have almost 700 net mineral acres, and that continues to increase. And we have around 290 future upside wells, which is very, very important, because if you look and you want to fund that has an exit, the acquirers are going to certainly want that upside. And so most people will reach out initially because of the tax benefits. Again, we're not tax advisors, so best practice is always, reach out to your tax professional that can legally provide you tax advice. The tax benefits for oil and gas investing are significant. We always target a $80,000 per $100,000 investment tax benefit, so that can be used to offset ordinary, passive active income, capital gains, et cetera. So if you had a liquidity event, if you have embedded capital gains, if you're doing Roth conversions, this may be a strategy that you may want to look at. But we don't talk enough about the return profile, and we can't promise returns. We can't, give hypothetical performance, because we just don't know the future, right? But we underwrite, the assets that we include in the firm, or in the fund rather, to have what we consider to be a successful ROI in the $60 to $65 range of oil. And so you can imagine, if oil is higher and significantly higher, well, in theory, you would hope that those returns would be significantly higher. So we target, what we believe to be a very, strong rate of return that could be used to offset potential, future market volatility. And when you look at diversification and you look at correlation of energy to the S&P, it generally, is not highly correlated. Now, it's always interesting, when everything is going up, you look at correlation, and then when everything is, going down significantly, correlation sometimes looks a little bit different. But if you believe that oil prices are going to continue to trend higher, or even stay above $60 to $65 a barrel, Bison 2 might be a strategy that you may want to look at. So 630-492-1912. We do have webinars that we really, again, it's education. And so in our webinars, we really discuss the strategy in greater detail. So you might want to look at it. You do need to be accredited. So accredited per the SEC is $1 million net worth, not including your primary residence, $200,000 of single income, $300,000 of joint income, with the expectation that will continue. And I believe also, if you do put $200,000 in a single fund, I guess the SEC now assumes that you are accredited. So again, 630-492-1912 if you'd like to learn more about that. We're going to talk about the structured note calculator that we are adding to the website. We'll talk about that after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC registered investment advisory firm, headquartered here in Oak Brook. So just outside Chicago. If you're not from the Chicago area, we are right across from the Oak Brook Mall. So 630-492-1912, 1912. Hopefully everybody is having a great summer. We are big proponents of running, RMDs and running, future taxable income from RMDs, what that is going to do. And if you have a 7-figure IRA, multiple 7-figure IRA, those tax implications can be significant. And so we really want to start to look at how we can plan, for that. And that's, what we do on the financial planning side. But 630-492-1912, 630-492-1912, if you'd like to have a conversation. I mean, we are one firm, one voice. We do work together, so it really doesn't matter who you talk to. But, when you look at kind of risk management, you look at diversification, and you look at, where the markets are currently, my personal belief is, candidly, is irrelevant as your personal belief, because what we think necessarily doesn't really matter. The markets are going to do what the markets are going to do, which is why I think you see so many various radio shows that are, annuity producers, or a large percentage of their business is, annuities, because, they pay a commission, and generally those commissions are significant. As long as the individual knows, what the commission is. I hear far too often that, the insurance company pays the commission. Well, they do, and it technically doesn't come out of your account, because if you put in $100,000, you see $100,000 on your statement. But I don't know if that's, being very transparent, because generally, at least it's our belief that the higher the commission, the lower the growth. We see so many people doing, lifetime income annuities. And when you look at, comparing, the bank notes versus, lifetime income on these annuities, it really, I think, comes down to a mathematical equation. And so if you're looking for cash flow, I really want you to start to at least include in your due diligence process the banknote strategies. And those are, I think the first one we did was 22%. The last one we did was 27%. But again, anything that's, pricing that high, there's volatility in those three individual names that we use, Meta, Google, Amazon. Those stocks can move, and you have 30% downside protection before you don't get paid a monthly coupon payment. But it certainly could happen that those stocks could drop, one of those stocks could drop 30% and you won't get paid that month. And so those are the things that we have to talk about. But we have created a calculator on the website, kuhncp.com, kuhncp.com. It's informational purposes only, but the calculator will allow you to put in, percentages of, if you put, 50% in tier 1, you put 40% in tier 2, and you put 10% in tier 3. What would that blended yield be if all coupons were paid? And so we're going to certainly make you click on a disclosure that you understand it's for informational purposes only. But we try to keep, we're going to try to keep that realistic pricing as far as what realistic pricing is currently. And we'll have, as you know, the most recent, generally, speaking, the most recent tier 1, tier 2, tier 3 notes, prospectuses, so you can read them. Now, that's an investment that has already taken place. And so when you look at future investments, obviously, the yields are going to be different. The banks are going to be different. The prospectuses, you still have to take a look at the preliminary prospectus, and you have to take a look at the final prospectus, et cetera. But it's, those are the things that I think, individuals want, because there's a lot of individuals that are searching for cash flow, that are searching for, if the markets do go down, do we have an investment that can still cash flow, that can still pay a coupon payment? And that's where and why, we believe the banknotes deserve some consideration in your due diligence process of, asset allocation. And when you look at, asset allocation, unfortunately, far too many people, will think they're diversified because of the number of investments that they own. And I guess that's a level of diversification, but how diversified really are you if you have, 20 ETFs or 50 different stocks. I mean, you're diversified, maybe small, mid, large, growth value, international, domestic, et cetera. But are you really diversified? I mean, it's still an equity. And then you look at, fixed income, and so many advisors are still using, basic fixed income strategies. And if you look at what the fixed income markets are doing today, you can do the research just like I can. I mean, we're still in the longest drawdown in the fixed income space. And these are not, that just is what it is. And so you look at, many fixed income strategies and you look at the indexes and you can just do AGG. And you can look at what, the 10-year number has been. And it's significant. I think it would surprise people. And so when we look at, what we're doing as a firm, I think, you have to make sure that you have a very good understanding of kind of contingency planning. And when we look at defined outcome investing, defined outcomes are just, the rules of the road going in, and it's, the prospectus, the bank writes it. If this happens, then your outcome is, this. And, we believe that, when you, well, I believe it because I hear people, reaching out to us, and I hear investors that have generally, some very, very high net worth investors that have had no exposure to the banknote space. And so we are working on putting our calendar up for the remainder of the year. And we don't want to do educational events that you're coming just to eat, or you're coming just because it's at a great restaurant. We've done those dinners, and, most people, if you have, live in a nicer area or more affluent area, you probably get those invitations in the mail all the time. And there's a cost there. And maybe that's why we've just never had a lot of success with, those types of events and turning those types of individuals into clients that, or, having those individuals that come to those dinners ultimately come on as clients, because we're just not very promotional in those events. And when you look at education, we want, there's really 4 areas that we want to educate investors on, and we're going to spend a lot of our time on and talking about, 5. Number 1, financial planning, of course. I saw an ad on, not an ad, but a tweet that said, 1-page financial plan. It looks good, right? You have a 1-page financial plan, but how much data can you really get off of a 1-page financial plan? And of course, they were selling, ease of use and whatnot. But then I started to look at the financial plan that they tweeted. It had nothing on tax strategies, nothing on, future, tax payments from RMDs. And just because something is easy, it doesn't mean that it's right. And, that is something that, so when it comes to kind of our areas of focus, obviously the financial plan is an area of focus that we want to spend a lot of time on. And our individual educational events that we're going to start to roll out, are going to, always, well, can't say always, but the goal is to always talk about how we view the financial plan versus what the average advisor does. And so, it's important when you look at, the financial plan to really look at the full financial plan and looking at and encompassing, the tax strategies and encompassing, RMD and Roth strategies, Roth conversion strategies where you've been told that, you can't convert because you make too much money, or it just doesn't make mathematical sense because you have, a high income. And those may be very true, but what if you had a strategy like, Bison 2 on the energy side that, energy funds have tax advantages, and how would that now change that Roth conversion story? So we'll talk about the other 4 educational events that we're going to spend a lot of time on throughout the remainder of the year after the break. 630-492-1912 630-492-1912. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I do host this radio show. I am also the with Kuhn Capital Partners, SEC registered investment advisory firm headquartered in Oak Brook. So we'd love to see you right across from the mall. KUHNCP.com is our website. KUHNCP.com is our website. Our goal, my goal, is to challenge conventional thinking. And it doesn't mean that conventional thinking is wrong, but to challenge conventional thinking of what the average advisor looks at as far as risk management. And if you're managing the money on your own, then you are the advisor, right? I mean, ultimately, the buck stops with you because you are the one that are making the decisions. And that's that is what we do. That is what we do as a firm. That is what gets me up. I always say kind of. It's kind of annoying me that I keep going to kind of, but that is what gets me up to go to work and to do the radio show, is to try to raise the financial IQ of individual investors. So 630-492-1912, 630-492-1912. If you'd like to have a conversation, excuse me. Generally, when those that reach out, they've been listening, to the radio show for an extended period of time. We're trying to get the message out. We're considering doing more webinars because individuals a lot of people don't like to come into the office. And now I'm happy that we have a lot of clients and a lot of potential clients that are doing due diligence on advisors that do come into the office. I love that. I love that we can, meet. I love that we can go over everything. I think it's still important to see people sit across the table from individuals. And it's important that if you're going to reach out, we're not going to talk above you. We're not going to make you feel that you're doing something wrong. Our job is just to help you think and challenge what your thesis is, or challenge what the advisor's thesis is of risk management, of portfolio diversification. And so we want individuals, just like especially when it comes to like Bison 2LP, the oil and gas strategy that we run. It's new. It's not new investment. It's not a new strategy. I mean, it's predominantly, private equity has owned the space, but it's new to most individual investors. And so it's, helping you think through that process of tax advantages of oil and gas investing and return profiles of oil and gas investing. And how do we incorporate that into an overall investment plan? And for advisors that just dismiss things out of hand, like we've heard many, many advisors, we have clients, and if you're listening, you know who you are, that are very wealthy clients, and they work with or have worked with many advisors. And in the bank notes and the structured notes, they will talk about those strategies to those advisors. And these advisors just dismiss them immediately out of hand. And I think it's a defense mechanism, because if you have a client that has significant assets with you that are paying you to manage their money, and you don't bring them a strategy like the bank notes, or at least have that conversation of what it is, because what appeals to individuals, and and it certainly is a selling point, is the ability to still receive a coupon payment as long as those underlying investments that the note is tracking are not down a certain percentage. And generally speaking, we will use that 30% downside. So that is appealing to people. People will ultimately think a lot of times, well, it's too good to be true. Fight the bank, right? Fight JP Morgan, Citibank, America, Goldman, BBVA, BMO, whoever underwrites the note, because it's a prospectus item. So if you think that they're putting something out that is factually inaccurate and they're going to do that, well, then don't invest, right? But what reach out or what appeals to individuals is just that. There's an investment strategy that the overall market could be down to a certain point and you're still going to receive a coupon payment. I mean, that's what appeals to people. When it comes to the energy strategy, the fact that oil and gas investing provides tax benefits, again, not a tax professional, can't provide tax advice, and I know I say it, but we want to be very transparent. Best practice is to always bring in your tax advisor. But oil and gas investing has significant, if it's the right strategy and the right investment, has significant tangible tax benefits. It's in the tax code. You can go read it. IDCs, TDCs, depletion allowance. But when what I don't know if it's 100% of the time, but it's darn near 100% of the time, that people that reach out for the tax for Bison 2 LP, it's because of the tax benefits. And we target an $80,000 per $100,000 tax benefits that can be used to offset taxable income, active income, passive income, capital gains, etc. That's a target. Doesn't mean that we'll achieve it every year. Doesn't mean that it's a reason to invest, because we don't know when we acquire an asset throughout the year. We acquire obviously significant assets. The tax benefits are very, very strong, right? But that's what appeals to everybody. So you have at least most people that we talk with. So on the banknote side, it's the ability to receive a coupon payment as long as, in our instances, the indexes or the individual equities or whatever the note is tracking are not down 30%. People like that. The fact that you can use an investment in the oil and gas space that cash flows, and we're currently that again is a target that we cash flow and has significant tax benefits and has a low correlation to the overall market. Well, a lot of people like that, especially if you're a high wage earner, if you sold a business, if you sold a property. You understand that it's what you keep, right? And so it may make sense to have an allocation to that. An allocation may be 1% of your portfolio, maybe 5%, maybe 10%. Who knows what that allocation is? That is where portfolio construction comes in. And then on the hedge fund side, on the Bison Alpha LP, again, very heavily tech weighted. But the benefit and the reason that people, at least we believe, the reason that people look at that strategy is the fact that the fund is able to have consistent flows as long as people invest, of course. I mean, but if the markets do go down and we still own, those same individual stocks that, represent the portfolio, we're dollar cost averaging when the markets are down. Where if you go and buy the Mag 7 or XYZ, stock, and the markets go down, well, unless you're adding more money to that stock or investment, you have to just sit and wait, right? So that recovery may take, an exception, or may take a longer period of time, where we believe the benefit of a fund is that is assuming, again, here, the key is that you have continuous cash flow or cash that comes into the investment, right? If you don't, then you can't buy the stock, right? But if the fund has money that comes in and we're buying when the markets are down, well, ultimately that subsequent recovery is probably going to look significantly different than you just going out and buying those individual stocks yourself. So, we believe that there are strategies, there are investments that are not readily talked about, that are not readily mass marketed. That doesn't mean that they're bad. It doesn't mean, generally, institutionally, they, like the energy fund. I mean, non-operated working interest space, that is predominantly private equity backed, where they don't need your 5 million, 10 million, 20 million. They certainly don't need your 100,000. And we're trying to democratize, when it comes to that strategy, getting access to oil and gas investing in the private space. And so those are the things that, we're trying to do. So go back to the calendar. Let's see here. Yeah. So go back to the calendar. We talked about the financial planning, topic, but we're also, when we have these educational events, we're going to talk about the banknotes. And the banknotes, it's not a pitch. It's just, here's what they are. You decide whether it works for you. And that's the beauty of these strategies. Then we're going to talk about Bison Alpha, which is the hedge fund. We're going to talk about Bison 2LP, which is, the oil and gas fund. And so we really want individuals who want to learn. And just because you attend a webinar or you talk with us or you attend an event doesn't mean that you have to invest, right? I mean, sometimes it's just not for you, and that's perfectly fine. So we try not to be overly promotional on the positives or of an investment. I think we try to balance the risks and the rewards of an investment so you can ultimately make a good decision for you. Because the goal is that you stay with us as a firm forever, right? I mean, isn't that the goal? I mean, and I see so many people out there promoting, strategies and they're just unrealistic in my opinion. And so yes, you might get a client, but is that client ultimately going to stay with you long term? Are they going to send you referrals? Are they going to share it with their friends and family? And, that's our belief. And our goal is to, that's what we want. And I think the only way that we can do that is to really help educate, on the pros and cons. So look for that on the website, kuhncp.com, the calendar of what we're going to do for the Q4. And we're going to, continue doing it through, live events and webinars in addition to radio. And we're trying to, grow the radio footprint because who knows what's going to happen in the market. I don't know. You don't know. But yeah, I mean, again, just as quick as I tell you, my gut feel doesn't mean anything. Because it really doesn't. But my gut feel is this market is different. My gut feel is that the markets, are going to continue to go up. And again, just as soon as I say that, I could change my opinion. But people want to look at this market and compare it to the 2000s or 2008. And while there may be some similarities, earnings are still there. And so I just see far too many people that are missing out on the growth. So 630-492-1912, 630-492-1912 if you'd like to have a conversation with myself or my team. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC-registered investment advisory firm headquartered in Oak Brook, Illinois. If you're listening in the Chicago market, you know where Oak Brook is. We're right across from the mall. If you are not from the Chicago area, we do work with investors in 24 states. Certainly reach out to us, 630-492-1912, 630-492-1912. Back to the calculator, kuhncp.com, kuhncp.com. We do have a structured note, blended. We do 3 tiers, and it's just, tier 1, tier 2, tier 3. Tier 1, we believe to be the most conservative. Tier 3, definitely, with the individual stock notes, those, certainly move. But the way that these work is, the more volatility or movement in a stock, generally the higher the yield. So we've been using, Google, Meta, and Amazon. But the calculator is going to be able to show you, you can put in a blended yield. And again, you never make an investment based upon a calculator. but it'll give you an idea of what kind of yields, blended yields you can get, whether you do 100% tier 1, 100% tier 2. We would strongly suggest never to do 100% tier 3 unless it's just a component of your overall portfolio. But you can increase the yield, pretty significantly by just having an allocation to the tier 3 notes. So again, the calculator is there for informational purposes only. It's education, but kuhncp.com, kuhncp.com. So when you look at, inflation, and, we're having a lot of conversations with people that are concerned. They're concerned with the rising cost of living. And if you're not on Twitter, I think Twitter is the amount of information that you can get on Twitter is significant, especially in the financial space. Now, I think the benefits of Twitter and the benefits of hearing from people that tweet that you just generally would have never heard from far outweigh, the endless scrolling that you might do. It's a net positive when it comes to, investing, in my opinion, the amount of information that you can get, on especially Twitter. But, when you look at, investing itself, the reason we do the radio show is to just try to get the message out of, different strategies that are not mass marketed, that you're generally not going to see, between, your favorite sporting event in your commercials that you watch, during the week and on the weekends. And that doesn't mean that, the investments are good or bad. It's just, generally the more intricate an investment is, it's, especially when it's something new. And I think, we get often asked, especially with the, the banknotes, is more times than not, after an investor fully grasps what it is and what it's not, the question will be, why doesn't every advisor do this, or why doesn't everybody do this? And why haven't I been shown this in the past? And I don't have a good answer for you. My thought process is that unless you grew up in the industry doing a strategy, generally speaking, most advisors won't incorporate something new because of the amount of work that's involved in educating, clients, or going back to a client and saying, hey, there's this new investment, and then risking, the client saying, well, why didn't you share this with me before? I'll be honest with you, the banknotes are very labor intensive from a management side, especially when you're doing volume, and we think we're doing significant volume. Like I mentioned in the first segment, I believe through July we were around 64 million in new issuance. So it means new notes that new money to the firm, notes that have been called, et cetera, et cetera. And that's just through July, so it looks like we're on a run rate of, over 100 million of new issuance through the year, the calendar year 2026. And I hope that continues to, go up tenfold, just because of our belief in the strategy of having it as a piece of the overall pie, as a piece of an overall diversified strategy. And a lot of times when the markets are just going vertical, you don't really see the value in the banknotes. Now, there is still value, of course, but when the markets go down and you're still clipping a coupon, as long as they're not down 30%, well, that is probably where we'll start to see people, their eyebrows raised and, say, wow, these are really strong. And we have to make sure that investors are not over allocating, to the banknote strategy. And again, every investor is different. Everybody's goals and objectives are different. I don't know yours at all. And so that's, why, when it comes to the radio, it's everything. My show, other shows, it's all information. It's you never invest based upon a radio show, a commercial, because what you think something is, it can be completely different on both the pro and the con side. I mean, so it's just all about education. So 630-492-1912, 630-492-1912. If you want to start to have a conversation, with us, and on anything we talk about on the radio, or anything that you've have questions on and you want more clarity on, we'll do our best to educate you to the investment as we believe it to be, whether it's good or bad, and I don't like saying good or bad, because that's every investment could be great. Every investment could be absolutely awful. It could be great for one person. It could be, awful for another person. It's just investments have pros and cons. And one of the reasons, we love, and I'm repeating myself now, but one of the reasons we like the banknote, structured note space that are issued by these banks, Goldman, JP Morgan, Citi, Bank of America, et cetera, is because they're defined. It's a prospectus. Read it, and read, past prospectuses. And so you can see that if A happens, the outcome will be B. If B happens, the outcome will be C. And I guess none of this matters if the markets just keep going vertical, but who knows what's going to happen. But been a great year, in a lot of instances, especially, with oil prices, and, how we think that in the impact that that's going to have on, Bison 2 LP, in the energy space. And unfortunately, most investors, even very, very high net worth investors, are they just don't have a good working knowledge of the oil and gas space. Most people think, well, if I strike oil, well, if that's the type of fund that you're investing in, which they're out there, believe me, your return profile better be potentially massive. Bison 2 LP is not that, especially when you're investing alongside, these operators in the Permian. It just is not that. And the more money you have, a lot of times, the investments that you're able to invest in, and again, not my requirements, are significantly different than just your stocks and bonds. But we still see, I read a great article that, the $3 to kind of $20 million, well, I don't know if it was 20, I don't know. It was 3 to maybe 10 or $15 million investor is kind of in no man's land, because you're, don't have enough assets for kind of the family office space, but you're still kind of, most advisors, who are working, with that space are still just utilizing just traditional assets. And, traditional assets are great, but if you can incorporate alternatives, what does it do to your risk return profile? And I don't even like the word alternative, because I think that, sets the connotation that it's, more risk or higher risk than just a traditional investment. And sometimes it is, sometimes it's not. But anyways, hopefully you got something out of this week's show. A lot coming on KUHNCP.com, KUHNCP.com. Make sure you check out the calculator. Again, informational purposes only on that calculator, but it's something that we think is going to kind of give you an idea of what kind of yields out there. But it's a lot going on. Fourth quarter is fast approaching. Can't believe that we're already at this time of the year. But if you'd like to have a conversation with myself or my team, we'd love to talk. 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.